In September 2008, a 158-year-old major bank collapsed overnight. Nearly $600 billion disappeared, people's retirement accounts evaporated, and millions lost their jobs. But the strange thing is this: the disaster actually began with a lie simple enough to fit on a billboard. If you're paying rent, why not own a home? The story rewinds from here. The year is 2002. America is still trying to recover from the dot-com crash. 9/11 has hit the economy hard, and Wall Street is tense and nervous. Then the Federal Reserve steps in and says that interest rates should be cut nearly to zero. Suddenly, money becomes cheap. Getting credit becomes easy, and the country's new hobby becomes buying houses. People go to the bank and are told, "Congratulations, you're approved for a $500,000 loan." The family is shocked and says they only make $40,000 a year. The answer is no problem. Adjustable rates, balloon payments, ninja loans. Ninja means no income, no job, no assets, but still a loan. At that time, owning a house was not just a roof and four walls. It meant status, security, and the American dream. Advertisements and billboards kept saying the same thing. Instead of paying rent, own a home. Banks loved this idea and began practically throwing money at people. Subprime loans, risky mortgages given to people with bad credit or uncertain income, spread everywhere. If your credit score was bad or you had none, it did not matter. You could still get a luxury apartment. When people asked what would happen if they could not pay, banks said the house would simply be sold for more. The housing market became like a gold mine. Prices rose, and homes doubled in value in months. Rules were ignored. Down payments were optional. Risk analysis was ignored, and oversight was slow. If you had a pulse, you could get a mortgage. People collected houses, banks created more loans, and brokers counted commissions. Everyone believed the lie that home prices always go up. By 2005, buying homes was no longer for security. It was for selling again at higher prices. Teachers looked at houses after work. People bought third homes with zero down, and even baristas got offers for penthouses. This was not investment, it was gambling. Meanwhile, subprime loans were rotting. Wall Street bundled these bad loans together and sold them as safe investments called mortgage-backed securities. Rating agencies called them AAA and very safe. Inside them were unemployed people and bankrupt borrowers. But on paper everything looked fine. The banks that issued them were also paying the rating agencies, and cracks began forming. These bundles were packaged again into CDOS. Trash was sold as quality investment. A small group of investors noticed the problem and asked what would happen if they bet against it. They went to Wall Street and asked for something that would pay them when loans failed. Banks created credit default swaps, insurance-like tools that let people insure investments they did not own. The system became like a Jenga tower. Every block was a bad loan, every layer was riskier, and executives celebrated at the top. Warnings were ignored and regulators did nothing. Foreclosures started, houses emptied, and prices fell. Subprime loans collapsed, and the investments built on them exploded. Banks realized their safe assets were toxic. Panic spread and investment banks lost billions. Lehman Brothers collapsed and disappeared. If Lehman could fall, anyone could. Banks stopped trusting each other. Credit froze. Salaries could not be paid and retirement funds shrank. By the end of 2008, the system was failing. Millions lost jobs, homes were taken, and the crisis spread worldwide. The government had two options: let everything collapse or save the institutions that caused it. They chose to save them with a $700 billion bailout called TARP. AIG received $180 billion, and GM and Chrysler received $80 billion. The Federal Reserve cut interest rates and printed money to buy bonds and mortgages.